Thank you very much, and Craig, thank you for setting up a great event here. John, appreciate you not doing the whole M&A spiel. We'll also add that to the end. So I'm going to provide the public market overview. Part of this is really to think, and what we wanted to do is focus on kind of 4 key areas of what the market really needs, and so how do we keep a well-oiled machine going. And so I think the first one, unmet needs, we know that. A predictable market environment is going to be key. Availability of capital that we spoke a lot about, John spoke about, and favorable performance. And so with each of these, right, innovation, it's in the name, that's why we're all here. We believe that we will get there. Healthcare is an inelastic good, and when we have innovation that actually meets needs, we're going to be able to have consumption of that healthcare. The unfortunate reality is that we want a predictable market environment, and that environment is not inelastic to what happens externally. And so healthcare is not immune whatsoever. So when we think about a market where we take 5, 10-year bets and we try to figure out how to get a return, any little marginal impact or change on the future plays a real role. So what we see, right, we all hear about macroeconomic trends and what's happening with inflation, the Fed, et cetera. And all of these external stimuli play a real role. If we think about for a company impact, that increase in cost of capital, just 100 basis point change, results in a 7% decrease on NPV. So if we think about where the Fed has been going and what we expect to continue, that plays a role. And so when we think about our internal economists as well as other global economists, we expect a Fed and policy-driven recession actually in the first quarter of 2023. There is debate as to how long that may last, and it really will depend on a lot of these external front page items and frankly, what we hope, right, is that we can see moderation, we can see the Fed start to slow down to enable, right, probably not the soft landing that we've heard all about, but at least a faster return to normalcy. And then as it relates to, right, the investor side of things, and we'll show, right, and we've also heard about it throughout, generalists become a little bit more cautious. Healthcare specialists also become cautious. As you reduce that pool of capital that's willing to deploy money, it becomes harder. That doesn't mean that these companies in this room are going to be able not to address that, but it does become harder. It becomes a little bit more of a slog. Add on top of that political activity, right? The Inflation Reduction Act has made a material impact. I had a lunch actually kind of right before the passage of the legislation, and there was some debate amongst investors saying, will this actually really happen? Because we'd heard about it for the last 25, 30 years. And we do hear from our strategic conversations as well as conversations with investors that across multiple therapeutic areas that it is playing a role. The nice thing is there is at least some now certainty which allows people to make decisions that we know where that stands. So then we also think about FTC. It's both the visible when they challenge things as well as the invisible, determines whether or not a company decides to proceed with a transaction. So all of these external factors become things that we continue to monitor because we need to have both predictability as well as the ability for future M&A and other things to keep a healthy market environment going. So then what we all are used to talking about, right? Supply and performance, right? You need capital and in order to generate any performance. But that also you can see in the accelerant. That happened during 2020, 2021, a huge amount of accelerant kind of poured onto the fire that you had a lot of capital trying to chase pretty incredible returns. Nowhere was that more prevalent, frankly, than in biotech, where you see what happened with the XBI, kind of shooting the moon right after COVID, but also experienced some rather low lows. Fortunately, we bottomed out a little bit, but where you really see that long-term performance over this period of time is that the largest companies are outperforming the S&P 500, but when you look at the subsector performance, here's where you see the smaller cap companies really getting hurt. And so you have this sort of flight to large cap pharma, higher volume, higher growth. And within the med tech category, you see that high growth category that still is outperforming the S&P 500. So when we think about the overall market, what we do need to see, right, is that doesn't mean that everybody in these lower categories don't have opportunities for return, but it does affect investor allocation and perception as they think about entering into these markets. So as we think about that allocation, right, we can think about just the IPO market. And you would look at these numbers and you'd say, goodness, this is awful, the sky has fallen, there's no IPOs. The reality, and John had some other lines about historical trends, we like historical trends, it looks a lot better when you really tried to isolate 2020 and 2021. The reality is that the picture is not nearly as bad if we can get back to a rate of 40, 50 IPOs a year. That's a healthy environment. There's still a lot of capital looking to be deployed, and that's where we can get to a point where there's still a lot of new innovation, et cetera, across multiple different therapeutic areas. But what we do need in order to bridge this gap is going to be performance. We talked a little bit about this before, but if you were to look at this about 18 months ago, you would see 2020 and 2021, those red boxes, right, those were all green, or those red pie charts. 80% of IPOs were up, and that resulted in 70 plus IPOs in both 2020 and 2021. In some cases, we can complain, right, that there were too many early stage companies. The reality is there are a lot of great companies that got public. Maybe the valuations have shifted, but what we're living with now is, right, how do investors think about deploying new capital in this particular environment? So that shut down, and you look at 2022. We've had a very light overall IPO year, but the performance actually has been quite good. Why has it been good? Frankly, these companies have had clear milestones and strong insider support to support these companies. And so as they think about continuing to progress, if these continue to move forward and hit their milestones, I think we have a lot of confidence that this will be possible to continue to get back up to that normal trend. So what does that mean from a follow-on activity perspective? For all these companies that are already public, it does very much depend, I think, oftentimes at the size and scale of the different companies. Certainly larger, more liquid companies have an easier time in raising capital. But much like the private market, there is more capital deployed to this field than ever before, and there are still deals getting done. We certainly have that gap, but when we really look at it on a more nuanced basis, follow-on volume has increased. We had a little bit of a dip, but on catalysts, on re-rating of either regulatory news or clinical news, companies are able to attract that capital. We've seen multiple financings in the last several months alone where we've seen billions of dollars of oversubscription, which is a very positive sign overall for innovation. Another positive factor, frankly, for all of this is going to be M&A. And I think we'll talk later about the overall environment in terms of the number of consolidators and the lament for consolidators in this field. But large cap medtech and large cap pharma are both driven heavily by growth. If you look at their PE multiples as it relates to their growth, there's a high correlation. And so they need growth very, very desperately as they head into both patent cliffs and as they head into basically limited pipelines without the ability to drive internal growth. And so you can look at the overall M&A trends, and you could also look and say, oh, biopharma looks way off. That's mega merger activity. But if you look at that dark blue line, both within biotech as well and within medtech, there's a nice steady trend of a need for general growth. And that we expect to very much continue because all of the consolidators, whether or not they're the largest companies that we use as a barometer, but also mid-sized companies that are looking for growth, are going to need more of it. When we think specifically about the ophthalmology M&A and licensing environment, I think there has been very much a trend between commercial scale companies, which has always been the case for the medtech community, but in the biotech community, really you do see commercial scale and clinical stage or preclinical stage gene therapy companies dominating the activity. What we do hope to see is perhaps more of that acceleration towards companies as they are in that NCE category or other kind of 505(b)(2) categories of moving earlier on in that execution and acquiring at a clinical stage or at clear de-risking. So what's the overall outlook for healthcare companies in this field, particularly those within ophthalmology? I think we've already monitoring, right, as we mentioned, the inflation environment, the Fed environment. That's going to play a very important role overall into macro trends, capital allocation. I think for the areas that will improve the performance within this field is going to be return of more consolidators and commercial performance for those that have upcoming launches. The reasons for optimism remain pretty much consistent with what we've said and what others have said before, but more capital being willing to deploy. Healthcare specialists want to do so. They have shown that they are willing to do so. And right, commercial players that do lack a pipeline and frankly are going to need to dip in and do business development activity. Happy to field any other questions and reach out if you have anything else, but otherwise, thank you very much for the time.